So I was recently reading an article by the New York Times that said over the last 20 years, 93% of actively managed funds have not been able to beat the market benchmark, which for those that don't know is the S&P 500 returns. It's averaged something like 12.6% a year over the last 20 years. But that begs the question, what about the other 7% that can beat the market? And what if I told you that I've actually been able to beat the market for many years now, and that in this video, I'm going to share with you one of the methods I use to do just that. I'll show you exactly how I pick stocks that can beat the market returns. I'll show you how to manage your risk, and I'll show you a very critical tip at the end of the video that can make or break your investing career. But before we do yourself a favor and subscribe down below, because this channel is dedicated to giving you the tools you need to become a millionaire. So if you can imagine a linear line, right, that represents time, and the current stock price is right here in the middle. So over here we have the past, and all current and known information about the stock is already accounted for in the price. Now, the further we go out into the future, the more inefficient a market becomes, because the future is uncertain. We don't know for certain what's going to happen. And where there's inefficiency in a market, there's opportunity. That's why 93% of traders are not profitable. They're playing in a market where all the known information is already accounted for and reflected in the price. So there's not very much meat left on the bone. This includes lagging indicators like RSI, EMA crossovers. All of those indicators are based on data that's already been publicly available. So just to simplify things, a very efficient market, all that means is that there's no meat left on the bone. Whereas if you have a very inefficient market, that means that you've got a nice T-bone steak there with plenty of meat on it. The efficient market hypothesis proposes that stocks always trade at fair value, making it impossible to consistently outperform the market in the long run by stock picking alone. But how? It's all about market information. According to the efficient market hypothesis, all known information is already reflected within the price. This means that only new or unexpected information can actually move the price in an unexpected way. So when you're trading stocks, you're not just up against mere human wit. You're up against a vast and ever-changing information set. You're up against machines that can react to that information within fractions of a fraction of a second. Essentially, beating the market isn't just tough, it's akin to predicting the future. But what if I told you there's a way to peer through the mist of time to predict how stocks might perform in the future? Now, I don't know exactly what you would call this method, but essentially what you do is you think into the future and you try to predict how stocks might perform based on certain assumptions. An example of this would be back in November of 2022, where ChatGPT was first released. Now, this piqued my interest because if AI advances very quickly, that means that they're going to need a lot of computing power. What type of computing power? Graphics processing units. And that's whenever I purchased NVIDIA, which has since rallied something like 400% over the last couple of years. Now, I don't do this with my entire portfolio. In fact, 90 to 95% of my portfolio is always invested in index funds, which offer a very reliable and stable return over the long run. And the beauty with these types of trades is they typically offer an asymmetric return, meaning that, if here's the price, that there's very little downside to them, but they sort of make this hockey stick type shape whenever the price increases parabolically. A stock could 5 or 10x if you're right, but if you're not right, then if you're invested in blue chip type companies or very stable, reliable, consistent returning companies, then your investment more or less stays the same. Actually, probably more accurately, would remain at fair value. Now, going back to NVIDIA, I actually invested 5%. The reason I did that is because I consider NVIDIA a blue chip type stock. It's not something that I imagine is going to evaporate overnight. In fact, I see, other than the AI play, I saw a lot of long-term potential with NVIDIA. So I'm always thinking about my exit strategy before I enter a trade. So what happens if I'm wrong in this situation? Well, NVIDIA continues to chug along as it has been, a very good performer over the years, and 5% of my portfolio isn't just wiped out. But the beauty was that I was able to take 5% of my portfolio and see that 5% increase by 400%. So for simple math, let's say my portfolio is $100, right? I take $5 of that and I buy NVIDIA stock. That goes up 400%. Now my portfolio is worth $120 just by a 5% investment. So that's a 20% increase in my overall portfolio. But that's not the whole picture, because I have the rest of my portfolio invested in index funds, which offer very stable, reliable returns. For example, my portfolio has mostly VOO, that's a Vanguard index fund, and it averages 12.86% a year. In other words, 95% of my portfolio went up an additional 12.86% each year for that same period. But because I made the NVIDIA trade, my overall portfolio increased about another 10% for the last 2 years, meaning I was able to actually beat market benchmark by 10%. Something like a 23% return over the last 2 years, just on that one trade alone. So if you're wondering, how do I determine what sizing to use whenever I take these types of trades, 5% is going to be my absolute max. And that's pretty much restricted for blue chip type companies that I see an opportunity in. And if it were to fail, or not this company fail, but if my hypothesis, my trade thesis were to fail, it would still continue to grow over time at the expected rates. It's not as if I'm buying a penny stock with 5% of my portfolio and then it just goes to nothing. So if you're wondering how do I determine how much of my portfolio I'm going to allocate to one of these types of trades, as a general rule, I'm never doing more than 5%, but most of the time it's going to be 1% or less. 5%, it's more reserved for blue chip type companies such as NVIDIA, companies that if my trade thesis doesn't play out, that stock is still going to continue to appreciate over time. So it's not really a loss, but I'm always thinking about my exit strategy in mind. I never want to take a large position in a company that if I'm wrong, the company just goes under. I have to have a very high conviction in order to take large positions. So time for the juicy bits. How do I actually pick one of these companies? Well, there are a few things that I look for, but first there's a quote from one of the best traders of all time, and somebody that has always kind of been not a mentor, but somebody that I've looked up to, is Jesse Livermore. Jesse Livermore says that it was never my thinking that made the big money. It was always my sitting. So kind of what he means by that is, if you're going out and you're constantly looking for trades, you're constantly trying to find that opportunity, you can see things that aren't there. You start seeing opportunities that don't exist. You start getting anxious and just wanting to make a trade where there isn't one. And so that's why I always let trades come to me. And the other point that he's trying to make here is that he lets his winners ride. You know, if he has a winner, he doesn't get scared, take profit right away. He lets it sit. He lets it appreciate. He lets it play out. He doesn't get nervous and get out too quickly. But for our purposes, we're going to focus more along the lines of seeing trades that aren't there. So in general, I tend to follow my intuition when it comes to these types of specific trades. And what I mean by that is, if I hear about something in the news or I see something that piques my interest, I have this aha moment and I start to look into it further. I don't actively scan the news searching for trades. I think that leads to you taking lots of bets that end up not playing out. So if I see something like I saw with NVIDIA, right? I had this moment where I was like, AI is coming out. That's going to need a lot of computing power to be able to process and to be able to think, essentially. And so what type of computing power do they need? Oh, they need graphics processing units. Who controls 80% of the graphics processing unit market? NVIDIA. And that's how I got that trade. So it's less about having a crystal ball where you can see the future and more about pattern recognition, because what you'll find is these types of trades have the exact same characteristics, or most of the exact same characteristics as all of the previous ones. For example, my largest winner over the last 10 years was Ethereum. They have a monopoly on smart contracts within the crypto space. They have creative destruction, so they're destroying the old technology of paper contracts and replacing it with digital money that's programmable. They have a proprietary technology and they have a network effect. You know, Elon Musk talks about this, where if you can try to think into the future on how, you know, what sectors or what companies would end up growing. I believe that he was talking about what types of companies he would want to be. You know, you mentioned things like space exploration, AI, technology, electric vehicles. And so if you try to think into the future, okay, how is society going to change? How is it going to grow? What are the needs that society will have? It kind of gives you an idea of what companies today will be extremely profitable within the coming years. So I'm always thinking into the future. Is this company going to replace another company that is old and outdated? In economics, that's referred to as creative destruction, where you have something that's new and innovative replacing something that's old and outdated. So a good example of that would be back in the day, whenever you had blockbuster movies, you would just go in there, rent a movie for, $5 or whatever it was, a couple dollars. But that ended up getting replaced by Netflix, because you have this new innovative technology where I can, instead of having to go to a physical blockbuster store and rent a DVD, I can just stream on Netflix. Those are kind of comparing apples to apples. Like, you have a DVD rental service being replaced by essentially a streaming service. I don't think that, like a movie theater, for example, I don't think that that's really comparable, because there is a whole experience with going to a movie theater, getting the movie theater popcorn, sitting down in the really nice seats, having the really nice audio. So you can't really compare a movie theater with a streaming service, for example. You want to make sure that whenever you're looking at creative destruction, you're comparing apples to apples and not apples to oranges. Anyway, circling back to the OpenAI trade, the ChatGPT trade with AI, since I couldn't invest in the company directly, I thought of parallel demand drivers that would benefit from the AI technology. Meaning, as AI were to grow, it would need more GPU, and so NVIDIA would benefit greatly from it. So the other thing that I look for typically is, does the company have a monopoly? OpenAI essentially had a monopoly on the generative text platform. They had the first mover's advantage. They were the most advanced, and so they benefited the most from it. If I was able to invest in the company early, I certainly would have. So again, does the company have a proprietary technology? They did. Does the company have a network effect? They did. ChatGPT saw viral growth when everybody and their brother was talking about it for months. Thus, that ended up driving growth for the AI as more and more people used it, and that drove more demand for GPUs. So the reason this method works is because there's speculative plays that you have to think into the future, where the market becomes more and more inefficient. There's more opportunity if you look into the future to try to determine what stocks are going to be most profitable. The future is very uncertain, and where there's uncertainty in the market lies opportunity. So thanks for watching, and don't forget to subscribe so I can provide you with more value. Until next time, take care.